China can lift up Africa, but much of it is left to Africa. According to Foreign Affairs magazine this week, across Africa, Chinese state media outlets such as CGTN have signed extensive content sharing agreements with local broadcasters and newspapers, enabling Beijing to distribute prepackaged pro-Chinese narratives through trusted domestic outlets at scale. Since these efforts are often uncontested, cash-strapped news organizations increasingly rely on free or heavily subsidized Chinese content to fill coverage gaps. Are Africans being deliberately blinded to risks in dealing with China, or are pro-Western mindsets exaggerating these risks? Can both be true? Meanwhile, the West is not giving up on vast Chinese markets. Nvidia told Chinese clients this week that its new Vera central processors for AI data centers could be available as soon as August, and that they can begin placing orders. This underscores fresh attempts to revive its rapidly declining fortunes in China as shipments of its second most powerful AI chip, the H200, to the country have stalled. The European Union's ban on public funding for Chinese-made solar inverters could impact over a fifth of new solar capacity in the bloc as it races to meet climate targets. Brussels argued that Chinese internet-connected inverters supplied could be used to disrupt Europe's power grid and could provide a backdoor for foreign actors to interfere with or even shut down electricity systems. Still on China, the US Pentagon reinstated Alibaba, Baidu, and BYD to a blacklist of Chinese companies seen as posing a national security risk to the US because of alleged connections to the People's Liberation Army. The Defense Department added the groups to its Chinese military companies list on Monday, signaling that the US may target them with more punitive measures in the future. Experienced and veteran Africa analyst and publisher of Africa Briefing magazine, Jonathan Offei-Ansah, comments on the entrepreneurial and business mindset needed to adopt in dealing with China. Hello and welcome to Global Business Insights, where we bring perspectives to help navigate an increasingly complex terrain. Today, China, often typified with the metaphor of a dragon, wise, fierce, determined, and able to weaponize massive state subsidies, is entering African markets. And what are some of the issues?
Are Africans being deliberately blinded to the risks of dealing with China? Or are some Western voices exaggerating those risks to preserve their own influence? The answer is that both can be true. Journalism works best when it is independent, not when it becomes reliant on content supplied by any foreign government. But there is another side to this debate. Much Western analysis portrays China as uniquely dangerous. Yet, Western governments and businesses continue to chase Chinese markets with remarkable enthusiasm. Not that China is a threat to be avoided at all costs, and not that Beijing's partnership should be accepted without question. The lesson is to think like an entrepreneur. A good entrepreneur never becomes emotionally attached to a supplier or customer. They negotiate hard, compare offers, and protect their own interests. That should be Africa's approach. If Chinese finance builds productive infrastructure, creates jobs, and transfers technology, embrace it. Why not? If Western investment delivers better value, embrace that too. But always scrutinize the terms, insist on transparency, and avoid over-dependence on any single partner. The same principle applies to information. African media should not become dependent on free Chinese content any more than they should uncritically amplify narratives from Washington, Brussels, or London. Editorial independence is a strategic asset. The continent's growing population, critical minerals, and expanding consumer markets give Africa a leverage. China knows it, Europe knows it, America knows it. The challenge is ensuring Africans know it too. So my view is simple. Don't see the world through Beijing's eyes, but don't see it solely through Washington's either. See it through Africa's interests. Because in global business, there are no permanent friends, only permanent interests. The countries that prosper are those that negotiate from strength, diversify their partnerships, and remain clear-eyed about both opportunities and risks. This is the entrepreneurial mindset Africa needs as competition between the world's major powers intensifies.
To other business news, mixed UK macroeconomic releases are not impressing the British pound bulls, nor are they providing any fresh impetus as the geoeconomics weigh on sentiment. The UK Office for National Statistics said the UK economy contracted by 0.1% in April as the impact of the Middle East shock was felt. UK industrial production also remained flat as compared to a 0.1% rise expected. The negative readings, however, were offset by a surprisingly 0.4% growth in manufacturing production. UK Defence Secretary John Healey resigned, followed hours later by Al Khan's, one of his junior ministers, citing Starmer's unwillingness to adequately fund the defence investment plan. The war in Iran is not dampening the appetite for huge deals. The rocketry and AI colossus SpaceX starts trading today on the Nasdaq. SpaceX yesterday priced the biggest ever US initial public offering at $135 per share, making Musk's rocket and spacecraft manufacturer one of the world's most valuable companies. It raised $75 billion, with the firm valued at $1.8 trillion, also potentially making Elon Musk, its founder, the world's first trillionaire. While its thriving satellite unit, Starlink, provides about 60% of the company's revenues last year, the space industry remains a question mark, with potential in space tourism, rare metals extraction, and running AI data centers for XAI in orbit. XAI today is far from being a cash cow, and space technologies are in very early stages, far from where they promise to be. All this as markets remain volatile given the war in Iran and rising inflation. Despite many investors warning that SpaceX is grossly overvalued, given its finances and issues with its governance structure, the IPO was well oversubscribed. SpaceX first trade indicated around $175 per share ahead of opening. Musk is also rapidly developing a chip 2 to 3 times better than NVIDIA's at 10% of the cost, or so he says. The chips will be integrated into Tesla's self-driving capability, claimed to be 4 times safer than a human driver. The new chip could deliver a 10 times boost in terms of safety and performance. The US dollar saw a lift after latest hot inflation data reinforced a higher for longer Federal Reserve interest rate stance. The US Producer Price Index was up 6.5% year-on-year in May from 5.7% in April, beating the 6.4% consensus. Also, the highest level since November 2022. On a monthly basis, the PPI jumped 1.1% against the market expectation of a 0.7% rise. The Fed is increasingly challenged by inflation drifting above its target, more so than it is missing its employment objectives. This raises chances of a rate hike this year. All eyes on how the Kevin Walsh-led US FOMC, that's Federal Open Market Committee, next week when they meet will play this, given expectations from Trump to keep rates as low as possible. This week, the European Central Bank raised interest rates by a quarter point to 2.25%, becoming the first G7 central bank to increase borrowing costs in response to the Middle East energy shock, also bringing rates to a level last seen a year ago. ECB President Christine Lagarde said it was obvious that with a major energy shock lasting longer than expected, the spillover in terms of higher inflation into the wider economy cannot be ignored. The Eurozone's annual inflation rate was above the ECB's 2% target for the third consecutive month at 3.2% in May, up from 3% in April. But in Germany, the inflation inched down to 2.6% in May from 2.9%. The ECB also cut its growth forecast for 2026 and 2027. The euro saw gains as analysts see more interest rate hikes later in the year. And on the energy shock, Brent crude was down over 4% after Trump cancelled planned strikes and signaled a potential deal as soon as this weekend. Markets will be cautious in digesting this latest bit of news, given a previous trend of high uncertainty related to a ceasefire deal. According to Iranian state media, a draft version of the Iran-US Memorandum of Understanding includes commitments from the US to lift oil sanctions and from Iran to reopen the Strait of Hormuz within 30 days. The Pakistani Prime Minister Shehbaz Sharif said that a final agreed upon text of a deal between the US and Iran has been reached. It also remains unclear how quickly and how low oil prices will fall, given that a depleted supply chain requires several months of replenishment to restore normal inventory levels and stability. Still, global stocks jumping, albeit cautiously, on signs of a potential deal, and oil prices tumbling below $90 per barrel for Brent. Again on Africa, in what could be a first for Africa capital markets ahead of the Dangote refinery IPO, $1 billion is being raised through a private placement at a $39.1 billion valuation. Demand was also reported to be exceeding $2 billion. The private placement closed on the 10th of June. In Nigeria, crude oil output rose in May 2026 to 1,530,354 barrels per day and 170,446 barrels per day of condensates, totaling 1.7 million barrels per day, and reinforcing its position as Africa's largest producer. May crude production reached 102% of Nigeria's 1.5 million barrels per day OPEC quota. This was as combined crude and condensate output remained strong, ranging from 1.51 million barrels per day to 1.86 million barrels per day. Excluding condensate, May's 1.53 million barrels per day crude output was the highest since January 2025's 1.538 million barrels per day. It was also a 15-month high. According to the regulator, the Bonny terminal led production streams with 293,870 barrels per day, adding that the rise was due to stable operations and no major pipeline or facility outages during the period. Completed turnaround maintenance also improved reliability and production efficiency. Well, that's it on this special episode of Global Business Insights. We are now on Spotify, Apple, YouTube, podcasts, and most popular platforms where you get your podcasts from. Don't forget, if you are a YouTube subscriber, you will need to press the notification button to be notified when episodes are published. Thanks for watching. Bye-bye.